The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The economic data stays the same, but the drawdown in the stock market resumes. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. So where is the Trump put, Romaine?
I don't know. Have you asked him?
No, I haven't asked him, but some are saying maybe at 15 to 20%, there could be a Trump put, different than maybe the 10% that we're seeing now. The S&P off by almost a full 1 percentage point, so close to correction territory that will bring us down 10% from the peak. NASDAQ getting hit the hardest, the big tech selling off down 1.3%. Definitely a Mag 7 story there. VIX moves higher, buying in the Treasury market, pure risk-off trade, Romaine.
Yeah, it would be nice if there really was a put out there for this, but right now we are looking at a resumption of that sell-off, and it really shouldn't be all that surprising. While there are certainly a lot of bargains to be had out there, the question is a bargain on exactly what? The buy the dip mantra only really works if you're convinced that the factors that led to the sell-off in the first place have actually dissipated. And the question is, have they? I thought Ed Yardeni put it best, lowering this year's estimate on the S&P, but only down to a best case target of 6,400. That's not really bearish. 6,400 actually implies 15% upside from today's levels and an annual gain of about 9%. And making that change, though, Yardeni expressed, I think, what a lot of folks on Wall Street have been saying. Quote, we continue to bet on the resilience of the economy. However, we acknowledge that it is being severely stress tested now by Trump 2.0.
Well, what we have seen so far is that U.S. exceptionalism is coming under pressure, and specifically U.S. growth exceptionalism is coming under pressure, and U.S. tech exceptionalism is coming under pressure. But let's be very clear, the current growth data does not point to us heading towards a recession.
And the data does reflect that. In fact, the two inflation prints that we got this week on consumer prices yesterday and producer prices today, they've actually really offered no clarity. Both reports were benign, but neither report reflects, or at least fully reflects, the stress tests on the economy right now from those Trump tariffs. For that, we may have to just wait a few more weeks, maybe even a few more months for that answer. So until then, the question is, and I'll pose this to you, Alex, is do you move to the sidelines, or maybe are you going to be greedy when everyone's fearful and buy this dip?
And buy that dip. And that's really the question we're trying to understand, because that makes it so if we have sort of a bottom and a base from which to move on. Maybe we're not there yet. So this is a great chart that shows how many sessions in a row we've been without back-to-back gains. We're currently right around 16. And you can see going above this 15 level is definitely not a norm, going all the way back to 2020. And there is sort of a push and pull within the market, Romaine. Last year, for example, remember, we went 356 days without logging a 2% decline. That's the longest winning streak since the Great Recession. And now it feels like those days are few and far between as the attention and the velocity is really to that downside. So where and how then should you be buying that dip?
Absolutely. Here, we should point out stocks off the lows of the day, but deep into the red here. That big rebound that we saw yesterday pretty much looks like it never even happened. Karissa McDonough joins us right now. She's fixed income strategist with Nottingham Trust, a division of Community Financial Systems, as we kick you off to the close here on this Thursday afternoon. And Karissa, I do want to just get your thoughts first on the shift in sentiment, because it just seemed like a couple of months ago most people in this market seem to be relatively optimistic, if not even euphoric, about some of the potential changes that might be coming that would benefit corporate profitability and benefit broader financial markets. Has anything really changed over the last 2 months?
Yes, thanks so much for having me on. I appreciate it. Yes, I think the biggest thing that investors have seen change is the kind of stability of the backdrop. Anytime, managers or investors are going to make significant business decisions, you want to operate it from a position of clarity. And that means, what is fiscal policy going to look like? What are business conditions going to be like? And I think that is the single biggest change that we have seen. There's been some volatility in terms of, tariffs are on, they've been removed. And so in that environment, you naturally would tend to move to the sidelines, whether it's in terms of, capital investment decisions or capital markets decisions.
And it takes a while, I know, for a lot of that to really feed through into the economy. If we do see material and more importantly, I guess, a prolonged pause in some of that corporate investment, and that does start to show up in a slowdown in economic activity, Is that actually being priced in right now, or are we going to have to anticipate further declines in order to get there?
That's an excellent question. I think that's the question on everybody's lips. I think if we're talking about kind of near-term fiscal policy changes, like, for instance, tariffs, we're not of the opinion that tariffs are going to be in place for an appreciable long enough time to really inflict damage. Again, it's the volatility of the backdrop. We are seeing some indicators that are pointing towards a higher likelihood of recession. Whether you're looking at some of the Fed models, the New York Fed or Atlanta GDP now, that's turned negative. Yield curve continues to flatten. Is this 100% certainty that we are headed to recession? Not necessarily, but the data points are headed in that direction. So the real question is, to what extent does this volatile operating backdrop persist? And that's what we think may hasten a recessionary environment if it happens.
Where do you think credit spreads go? In that, we've seen credit spreads get a little bit less benign, but still not indicating the kind of stress and fear that we've seen, say, in the equity markets. Which one will catch up with which?
Oh, excellent question. We think that even though you've had some degree of credit spread widening, it is nowhere near medians, and it's really nowhere near attractive levels. We do think there remain opportunities, particularly in financials. The systemically important financial institutions continue to provide some degree of opportunity, but regular industrials, we don't believe that we've seen the kind of spread widening that this type of economic environment would merit. So our opinion is spreads will continue to widen. We've seen the way being led by high yield spreads, which are following equities, and I think equities are leading the way.
So what role then does fixed income play in your portfolio as we start to see these cracks widen?
Excellent question. We think, even though Treasury rates have come down something like 0.5 percentage point over the last couple of months, we think Treasuries and mortgages, those remain excellent opportunities, particularly in this environment. Even if we're not necessarily headed into a recessionary environment, if the economy is slowing and you think that interest rates are a combination of growth and inflation expectations, then we would expect as growth continues to slow, those interest rates are going to remain capped. And I would note that implied forward rates don't even expect interest rates to breach 5% over the next 5 years. So in that environment, you just go ahead and buy fixed income and clip the coupon, and it's a nice, 4 to 5% type return here over the near term when you're not sure about what's happening with equities.
And it's funny you mentioned that too, Karissa. There's been a lot of talk here about how, at least on a year-to-date basis, if you were in fixed income on a total return basis, you're way outperforming right now the equity market here. On an investment grade level, it's something like a 6 percentage point differential, and even on Treasuries, it's pretty sizable, I think 4 to 5%. I am curious, though, about the sustainability of that. If conditions stay the same for the foreseeable future and sentiment stays the same, do you see steam running out of that fixed income trade, meaning the returns and that differential with stocks maybe starts to narrow?
Oh, that's something that we're always trying to take a look at. We believe that you are at least going to continue to clip a coupon in fixed income, even if you're not going to get that price return, which we think there still is some legs left in the price action part of the equation. But we think, again, if you've gotten something like a 4% return in Treasuries already year to date, well, then just put on the rest of the coupon that you should be getting for the rest of the year, and you're still looking at, north of 5 to 6% possibly. So no, this has not lost steam. Fixed income remains an excellent opportunity.
Absolutely here. And I was just pulling it up on the terminal right now, a 7 percentage point difference between the S&P and what you would get on investment grade debt, at least based on the Bloomberg indice that tracks it. Karissa, always a great conversation, always insightful. Karissa McDonough, fixed income strategist at Nottingham Trust, kicking us off to the close here on this Thursday afternoon as the sell-off resumes and a bright spot in a muddied week out there for retail. Investors raking in the dollars from Dollar General. We're going to talk about that stock, one of the few bright spots here on the day.
All right, plus a look at investing in the metals space with tariffs boosting benchmark sheet steel prices by nearly 50% this year. And that's according to Timna Tanner's managing director of equity research at Wolfe Research. A sit down with her up ahead.
And from tariffs to tech, a discussion on the future of AI and how it could hinge on the number of chips it uses. We're going to talk to the chief of AI products and solutions over at Workato. That's coming up in just a bit. Stick with us. This is The Close on Bloomberg.
European alcohol stocks taking a hit after President Trump threatened to impose a 200% tariff on wine, champagne, and other alcoholic beverages from the EU. This is in response to the EU's plan to tax U.S. whiskey imports. And this is just the latest escalation in the ongoing trade war. Joining us now to discuss is Chris Swonger, President and CEO of the Distilled Spirits Council of the United States, the industry's top lobbying group. Chris, I'm sure your members do not like this. What is the active dialogue you're having right now with the Trump administration?
Hectic morning, no doubt. First and foremost, let me just recognize and acknowledge, the big issues that President Trump is trying to tackle. Reducing the U.S. trade deficit, more American manufacturing jobs, and so forth. But our industry is unique. I mean, really, for years we've been the model for fair and reciprocal trade. In 1997, the U.S. and the EU agreed for zero tariffs for the spirits industry. Mm-hmm. And that lasted until June 2018, when the president was leaning in hard for more steel and aluminum production. And unfortunately, our friends in the EU broke that barrier, where we had 450% growth during that time on both sides of the Atlantic. And the EU imposed a 25% tariff on American whiskey, which was really unfortunate. Got our industry back and forth, intertwined. So
does that mean you're a fan of the reciprocal tariffs then? You think it's fair for the U.S.?
No, we support fair and reciprocal trade, of course, and that means our industry across the Atlantic has thrived and generated a lot of growth with zero tariffs. When the tariffs were imposed on American whiskey for a 3-year period, American whiskey lost 20% in American whiskey exports to one of the greatest markets, the EU. So, look, we appreciate that President Trump is a deal maker, and there is an opportunity. If the EU is willing to play ball and they export a lot of great distilled spirits here in the U.S., where American consumers love it, there is a good rationale and a business case for the United States and our economy here to cut a deal and get us back to zero tariffs. And we're looking forward for the president's leadership to help us do that.
Is that realistic, Chris? Is that actually going to happen? Is there any chance that even happens?
I am optimistic, because between 1997 and 2021, the industry enjoyed 450% growth. Yeah. So that's number one. Number two, and let me just, if I may, tell this story. 20 plus years ago, there were only 60 plus distilleries in the United States.
Right.
So 20 years later, there's 3,100 distilleries. These are many small mom and pop craft distilleries that have popped up in communities all around the country.
Oh, yeah.
A great opportunity for growth is for those great distilleries to be able to export.
Yeah.
If there's a 50% tariff on American whiskey or any American distilled spirits, those distilleries won't be able to do that. I think we'll get...
Well, talk to me, Chris. Sorry to cut you off here. I just want to make sure we get these questions in before we run out of time. I mean, what's the contingency plan? Because, I mean, right now we're talking in hypotheticals about what the White House may or may not do, what the EU may or may not do. What we know is the tariff threat is there. The retaliatory tariffs threat is there. We're seeing stuff pulled off the shelves in Canada. We're seeing other sort of forms of protests in Europe right now here. If the members of your organization can't export to Europe or to China or to Mexico, what other option do they have to pick up that slack?
Catastrophic, really, across the board. The beverage alcohol industry has constricted a little bit over the last couple of years, and it's tough times right now, and the industry is very, very anxious. But of course, I'm focused on the bigger opportunity, and tensions are high. And we recognize that, but our industry is about toast, not tariffs. And I think we could utilize the president's leadership.
Have your members started, or at least tried, to front run some of these retaliatory tariffs, meaning get as much product out the door and overseas as quickly as possible? Is there evidence of that?
Look, I can't speak on behalf of one member versus another, but we've been enthralled at a tit-for-tat tariff battle since June 2018, unfortunately. And certainly every company is trying to contingency plan. This is going to have an impact on the bottom line. And ultimately, it'll have an impact on American consumers and the greater hospitality industry here in the United States.
All right, Chris. Well, I wish you all the best. Obviously, something near and dear to, I think, all of our hearts when it comes to the American liquor industry. Chris Swonger is the president and CEO of the Distilled Spirits Council of the United States. When we come back here, we're going to take a closer look at consumer spending, and specifically Dollar General, its latest quarterly report, providing maybe some silver linings here about the economy. That discussion when we come back. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls. Big movers on the back of analyst recommendations. And we start off with the sell rating for the fertilizer company, Nutrien. Excuse me.
Right.
Goldman Sachs starting coverage with expectations that the stock will underperform its peers, given the company's higher exposure to the potash market, which has, in his words, the least favorable demand outlook. Those shares down about 1.8% on the day. Next up, let's take a look at Vivid Seats, a downgrade to underperform at Bank of America. The analyst says persistent competition is weighing on growth and the share price. And with the upcoming slate of concerts and sporting events this summer, Vivid may now have to defend itself through higher marketing spend. Those shares at $2.80 a share, that is a record low for that stock. And finally, Microsoft raised a buy at D.A. Davidson. Analyst Gil Luria praising the company's more rational approach to capital expenditures. Luria also calls Microsoft the best position of the Mag 6, in his words, for a consumer slowdown since it has the least exposure to consumers. Those shares, though, down 1% on the day, and those are some of our top calls. We do want to stay with the consumer space and take a look at, well, a more of a pure play. Dollar General, the discount retailer, out with earnings, and it did give analysts a sense of relief after that print did show better than feared results. The shares up about 5% on the day. Karen Short joins us right now. She's head of consumer and retail research at Melius, and she currently has a hold rating on the shares. Did Dollar General do something right in this quarter, or is this just kind of like coming from such a low base, almost anything they reported was going to be received positively?
Well, a couple things. One, historically their valuation, and I look at EV/EBITDA, but not P necessarily. Historically, that has been kind of anywhere in the 12 to 14% range, and it's very much below that. What we reported today and published was thank you for not growing and not publishing growth and not forecasting growth, because in our view, you can actually have a multiple that does not reflect unit growth. So unit growth does not necessarily justify multiple. And so what they did today was to lower unit growth, and that we applaud.
Okay.
Meaning,
well, it gets to the broader issue, though, too, about sort of where Dollar General fits into the broader consumer landscape. I've heard so many arguments being made that if we hit upon economic hard times, that somehow they'll be hurt. I would think that people would, in theory, be trading down to a Dollar General if we did get to those types of economic conditions. Are they not in a position to benefit?
well, they are, but they have also, Walmart has been a meaningful competitor, much more so than they have in the past. They have made a strategic decision to, lower unit size, lower unit or lower price size per unit. And historically, what's happened with dollar stores is that consumers go to Walmart for their first of the month actual purchase, and then they go to dollar stores for their end of the month purchase. But if you have Walmart going to lower pack sizes and Walmart going to lower price points, it takes away the reason to go to Dollar General, and gas prices are definitely a factor. But Dollar General is executing, so it's a very competitive environment.
So that's what was interesting about the stock move, like up 5%. They delivered, right? But it felt like it was just not that bad, right? Like it wasn't as bad as maybe some had worried it would be. That doesn't feel like a quality beat.
I agree. I mean, I think the lower unit growth is definitely a positive. I think they need to show low or higher ROIC, and they need to show that lower unit growth will drive ROIC. So it's a bit of a show me story, and it's been a tough year for Dollar General, but Walmart is getting better, and Walmart is going for the jugular on all retail. It's not just Dollar General.
Yeah, and also at the same time, everyone has to deal with the tariffs and the issues and supply and all of that, and pricing and margins. Where is Dollar General and Dollar Tree kind of set up for that?
I mean, Dollar General is very limited on exposure on tariffs. They do have this non-consumable initiative that they call NCI, but they can reconfigure their landscape within the stores to have less exposure to that specifically. But they're very much more oriented to consumables that are not tariff oriented. Dollar Tree is very exposed. There's no way they can get around that. Most of these retailers do have inventory that they've already brought in, and they brought that in through, I would say, inventory is good through May. Dollar General is much more, I guess, sheltered from that perspective.
All right, Karen, we appreciate that. Thank you very much. Karen Short over at Melius Research joining us there. I'm on correction watch. There we go. 10% down now for the S&P from its peak that we saw in February.
Yeah, and it'll be interesting to see. We traded at that level the other day. It'll be interesting to see if that holds into the close. I just want to point out, though, just on the spending side, too, because I was going through all of the S&P sector, the 11 sectors, and I think now 7 of them are in correction territory. But discretionary stocks, now in a bear market, they're down 20%, more than 20% from that all-time high. Obviously, staples have held up a lot better, but there is this concern that if consumer spending falls off a cliff, it's not just going to hurt the discretionary names, it's going to hurt the staples companies like Dollar General.
Absolutely. Yeah. Although discretionary, that's also Tesla, right?
Yeah, but even if you back out Tesla, it's still down about
it's still in
yeah, but Tesla
territory?
is in that index.
Interesting. All right, coming up, it's the battle of the metals of the U.S. versus Canada and the EU. We're going to get more perspective from the South Side with Timna Tanners of Wolfe Research. This is The Close on Bloomberg.
Any chances that you will ban on the tariffs on aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your mind?
No, look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years.
President Trump at the White House earlier today speaking about those steel and aluminum tariffs, day 2 that they are in effect, 3:30 p.m. here in New York. I'm Romaine Bostick, and this is the countdown to the close.
And I'm Alex Steele, taking a look at the S&P now from that high that we saw back in February, now down 10.13%, sort of chasing the NASDAQ 100 as well as the NASDAQ down lower to that correction territory.
And that's a lot of people are looking at these tariffs and some of the other economic policies and wondering, is that going to have a material drag on the fortunes of these companies? The The problem is we haven't actually seen that show up yet. It's just more the fear of it happening.
And it's also soft data to the hard data. We get the UMISH tomorrow, so interesting to how that's going to feed through to those inflation expectations. But again, at some point, if that feeds through to the hard data, that's when we start to get that cycle.
Yeah, and I think the steel and aluminum tariffs are really having a big impact on psyche because obviously we're talking about base metals that feed into so many products, cars, as the president just mentioned, but of course everything else, including, baseball bats for your kids or, maybe, I don't know, what type of jewelry you wear if you're like kind of steampunk or something.
Totally. Obviously.
Okay.
Did we not know that? Obvi.
All right. Let's get back to it. Timna joins us right now. She's Managing Director and Equity Research Analyst over at Wolfe Research. Talk a little bit more about these tariffs and more importantly, some of the moves that we have seen so far in the metals market and maybe some of the moves to come. And I want to start with steel. We used to have a big steel industry here. It is obviously a shadow of what it used to be. We've already seen a pretty immediate response in prices in the market. I'm curious as to how far they've gone up so far and how much further you think they could go, assuming the tariffs stay in place.
Sure. So I think the steel industry has remained pretty vibrant. I think you've seen an evolution over the past several decades that I've followed the space from a certain type of blast furnace to electric arc furnace. But honestly, the steel industry has been pretty healthy now for the past couple decades. It had a very strong environment during COVID, probably unsustainable in our view. The price hikes since the beginning of the year have been about a benchmark hot rolled to $950 from about $650. So quick math there is pretty almost 50% increase, right, in the amount and the price of steel. So that's been in anticipation already of these tariffs. The U.S. steel industry probably could be self-sufficient, but it's not quite yet. So having tariffs does, spur an increase in the prices, and the mills are enjoying it for now.
Well, that's what I'm curious about too. Is what type of benefit could that have for the existing steel producers out there? But also this idea that whatever we lose in terms of imports, assuming that people aren't willing to pay that extra 25% tax, is there any capacity left in our system domestically that could make up at least some portion of what would be lost through imports?
Yeah, so a couple points is that one is that this isn't an increase of 25% across the board. It's kind of a restoration of 25% where there were exclusions when Section 232 was first announced. Okay. So it does make a difference for sure. I'm just, it's not quite an added slap of 25% across the board. And actually, like I was saying, with the increase in prices, the incentive to import is still there because the price has gone up more than 25%. So it's just a question of how that plays out. Are the consumers willing to take the risk of buying import if there's an additional tariff that Trump has said he could put on, right? Gotcha. So I think that's another shock and awe kind of factor there. And in addition, the steel industry could be, we believe, almost self-sufficient, right? There's some products we just don't make in this country or that we only make a little bit of, but their spare capacity utilization right now is about 74, 75%. Okay. It could comfortably be over 80%. And
so why isn't
the mills are holding back,
But why? Like, why isn't it at the utilization that it could/can be?
I think the short answer is the lower the utilization, the higher the price. And I think they're enjoying the higher price rather than producing more steel.
So if the actual underlying metal then has a higher price because of the tariffs, does that help make this more economic?
Yeah, so higher prices should spur production and should spur restarts. In addition, by the end of the year, we expect about 4 million tons from added capacity that's been planned for years. That's on the flat rolled side. On the rebar side, we have 1.5 million tons and several new mills being planned and will start up in the next year or so. So within the steel industry, we do see the capacity for domestic production to replace imports. And we also believe that at today's prices, there'll still be a decent amount of imports.
What about aluminum? I mean, we're talking 4 smelters, active smelters right now in the United States.
Right. At the beginning of the century, that was 23 smelters, I believe. Wow. So the aluminum is definitely a different story, right, where the industry has been somewhat decimated. You could argue China built a lot of capacity. You could also argue, high power costs in the U.S. crushed the industry. So you need consistent consistent low-price clean energy to be able to support a competitive aluminum environment with the rest of the world, right? Because it is more of a global commodity. So the U.S. only produces about 50% of what it needs. Most of the rest comes from Canada, and that arrangement was, I think, pleasing to everyone on all sides until recently.
And it's going to get harder, right? Because then if you wind up having all the power demand suck for energy, where's that aluminum plant going to get its power?
Yeah, absolutely. But also to that point, too, I mean, if we're talking about trying to make up for whatever is lost, is there some sense here, though, on the aluminum side, that if prices were to go up materially, that there is either enough demand that would take that price, or more importantly, are there end users that could find substitutes to whatever aluminum that we would normally get either from Canada or from elsewhere around the world?
So the U.S., with the increase in price in aluminum that has also been quite substantial, will still have to raise the price of aluminum in the U.S. to draw the necessary aluminum to fill the gap of what is not produced here. The nuance, the wrinkle, if you will, is if we do have tariffs on Canada, then that means that production has to come from Europe. Right. But I think at the end of the day, the question I think you're asking is, do we just build more production in the U.S.? Does it change demand? On the production side, here's the wrinkle, is that it takes 3 to 4 years minimum to build a new smelter. It takes $3 to $4 billion. And how do you make that decision if some of these current tariffs are executive orders, may or may not be around after Trump is no longer president?
I was talking to Jeff Curry over at Carlisle about just this point, and he was like, again, it takes so much energy to run an aluminum smelter, like a lot. And like, we don't even have enough right now for all the data centers that we're going to build. Like, how do you add that onto the grid as well? Are we going to see demand destruction if prices keep moving higher?
You know, so far, I think on the beverage can side, I don't think it's as scary as what some people have mentioned. I don't think we're going to go back to plastic. I think the can cost is going to be a couple cents. And in the consumer sector, they could probably absorb some of the hit. The problem is really automotive. So I'm not the automotive analyst, but you've heard some of the estimates out there of thousands of dollars of increased costs from Canada and Mexico, and the cost from steel and aluminum going higher. If aluminum becomes really less competitive, do they switch back to steel? It wouldn't happen right away, but it could over time. And already, I was talking to someone today who lost a job for an international project because the U.S. steel cost was so much higher than a steel produced elsewhere. So on the margin, I think these things hurt. But I think ultimately, downstream tariffs, other tariffs do help the steel industry and help utilization better than it would otherwise be.
All right, Timna, really great. Always wonderful to chat with you. Timna Tanner is over at Wolfe Research. Oil is another commodity impacted by trade wars. The International Energy Agency warning that consumption will be under pressure. The White House still advocates drill, baby, drill, with the Energy Secretary Chris Wright advocating $50 oil. Earlier today, I spoke exclusively to Harold Hamm, chairman and co-founder of Continental and a pioneer of the share revolution. And he sat down with me earlier to discuss the energy environment and why the industry needs $80 oil.
When you get below the cost of supply, you can't drill, baby, drill. That shuts you down. And certainly there's a lot of fields that are getting to the point that's real tough, to keep that cost of supply down to where you can come out at the end of the day.
So how do you understand then the drill, baby, drill and the $50 oil price relationship? They don't seem like they can coexist then, from what you're saying.
Well, that's true. When you get down to that $50 oil that you talked about, then you're below the point that you're going to drill, baby, drill. And you asked about tariffs a while ago, and I'll comment one thing that really affects us. One thing that we use a whole lot of is steel. And we'll have to see how this washes out with steel tariffs. And we've been in contact with our suppliers, and that's another thing that can add a great deal of cost to what we do. All the pipe that goes in the ground and the tubulars that we use, that's permanent. When you drill a 2-mile deep well and 2 miles out to the right, 4 miles of tubulars, casing and tubing to complete that well. There's a tremendous amount of cost that goes into it. So seeing how these tariffs play out in the end is going to be important.
And you were very close with Secretary Wright and President Trump. What have the conversations been like when you lay out the argument or lay out this position?
Well, he understands, he wants to see steel manufactured, tubulars manufactured here in the U.S. And thank God we have some manufacturing capabilities in the U.S., and we use those suppliers, but they can't supply it all. And that's where we're at. So, that's a conversation that's going on.
And what about when it comes to the oil price with Secretary Wright? How do you have that conversation?
I have not. I have not had that conversation with him. You know, he and I are good friends and understand each other quite well. So I look forward to that conversation.
So you're going to lay it out for him and say, look, man, look at the cost increases. It's too hard at 50. You think he'll listen?
Let's say where you're at with 50. Yeah. What fields are you talking about?
Right. Oh, well, I'll bring that up because it means that certain fields can do 50, but other fields you need more because of the other cost inputs.
Yeah, you have some fields that are, certainly better, a lot better than others, and other fields that are not. So all those factors play in. The gas-oil ratios, everything plays into the economics of and cost of supply.
That was Hamm, chairman and co-founder of Continental Resources. But the idea is like you cannot produce at 50, not because you might not want to, but because there's just so many other cost inputs, and in particular labor, which we didn't wind up getting to. And there can be incentives, like more land opened up, maybe like less leases, less cost for leases, lower taxes. But still, there's got to be a trade-off in order to just keep the oil flowing.
Yeah, absolutely. And we've heard that from other guests on this network who've said that in diplomatic ways, let's just say. And I would love to be a fly on the wall to see what these CEOs, these oil and gas CEOs, are actually telling the president. And a lot of them who, of course, supported him during his campaign. Yep.
And Secretary Wright used to run Liberty Energy. So he's a straight up oil and gas guy. He's done other commodities, too. But so he also kind of gets it. And we were talking about that, too. He's still sticking at $50. But, you know, he understands that, say, tariffs on oil from Canada is also tricky and hurts refiners at home in the U.S. as well. All right. Well, we are keeping an eye on the commodities space. So oil continues to be on the back foot, down 1% on the day. We want to get back to the stock market as we move closer to the closing bells. And one of the few bright spots on the day is Intel, biggest gainer on a percentage basis right now in the S&P 500 after the company said it had found its next CEO. Lip-Bu Tan, basically a venture capitalist and a veteran of the chip sector, will start his role next week, and he's expressed confidence in being able to turn the business around. Ian King joins us right now, our man out west who covers everything chips for us here at Bloomberg. And I have to admit, Ian, Tan was not a name that was really in my zeitgeist, but the more I read up on him yesterday, it certainly seems like he has the chops to do this job. What's been the response by investors to his naming?
Yeah, I mean, you've seen obviously an excited response in the stock market, and that could be one of two things. Either they like the fact that somebody's in place and it's time to execute on the plan we've got, or he's perhaps going to be the guy that ushers Intel into the history books and allows the split up that we've been seeing rumored across the media and also the stock market. Maybe that's the scenario where everybody gets paid as well. So we're not quite sure which way it's going to go yet.
Ian, didn't he say he was going to continue the strategy that Pat Gelsinger laid out?
Yeah, I mean, there was a very limited, in terms of details, statement sort of put out by him, which was an internal email. That indicated we have to make Intel a world-class foundry, which means an outsourced chip maker. That was certainly part of the previous plan. But whether that outsourced foundry becomes its own company or not, that wasn't made clear.
I am curious, Ian, with regards to Tan's background. I mean, I know he spent most of it kind of basically financing other companies, investing in other companies here. Is he kind of looked upon, though, as having the technological chops to run a company like Intel?
I mean, he's, a super brain with all, MIT background. So, yes, in that regard, yes, he's got the physics and everything that you would need to know in terms of understanding the industry. So that's not the issue. And he certainly spent a decade at a company called Cadence, which is electronic design for semiconductors. So he has a lot of contacts and, he's definitely of the industry.
Yeah, Ian, thanks a lot. Really appreciate Bloomberg's Ian King joining us there. You know who he's not?
What?
Larry Culp.
Oh, my gosh.
Well, because that was the rumor, right? Is that you get a guy who's really good at restructuring and knows how to manage a company that's deep in crisis like you did with GE. That clearly doesn't happen. Of Lifer, does that say a significant change in direction to you?
I don't know. I mean, I guess that's what I'm trying to figure out. On one hand, he is an outsider. On the other hand, I don't know. Did you want a Larry Culp, a restructuring strategist, or did you want somebody who's more cut from the grains of Silicon Valley and the tech world?
I don't know. I just wonder how long he has until he has to sort of show something. All right, coming up, we are about just 15 minutes away from the closing bells. The S&P goes into correction territory. Jason Pride will be joining us. This is Bloomberg.
If we're talking about kind of near-term fiscal policy changes, like for instance tariffs, we're not of the opinion that tariffs are going to be in place for an appreciable long enough time to really inflict damage. Again, it's the volatility of the backdrop. We are seeing some indicators that are pointing towards a higher likelihood of recession.
Karissa McDonough over at Nottingham Trust kicking us off to the close just about 50 minutes ago, Alex. And as we were in the break now, it looks like we're retesting the lows of the day. Remember, we opened around 55.94. The low on the day on the S&P was 55.04. We're basically back down in that range right now, down 1.5%, and more importantly, 10% from that record high.
Yep, 10.32%, just to be exact. I have the chart and I'm watching it. Closing on the lows of the session and then lower from that area as well. It doesn't set us up really well getting into Friday. Consumer discretionary are really underperforming within the S&P. Romaine, as you were pointing out, that's been one of the hardest hit sectors since we started the downdraft. You're also looking at the NASDAQ 100 down a full 2 percentage point. The Russell is also down. Getting hit less hard is the equal weighted index for the S&P, but even that rolling over.
Well, that's what I'm curious about, too. I was trying to look around like where the bright spot. I know there's some idiosyncratic stories, but are there sort of broad bright spots in this market right now? Meaning, is this a sell-off or is this more of a rotation?
Equal weighted index is only off 1%.
Okay.
I mean,
right.
Is that a thing? Is that something that we can pin our hat on here?
Yeah, it's a thing for somebody. I don't know. Maybe our next guest can answer that question. Jason Pride knows a heck of a lot more about this than I do. Chief investment strategist and research over at Glenmede. All right, Jason. In all seriousness, though, we talk a lot about this sell-off, and this has kind of been about 3 weeks now, more or less, that we've been churning like this downward. And I am curious, is this money going out of the market, or is it simply rotating to other pockets of the market, pockets that, understandably don't have the same weighting that the big cap names would?
First, thanks for having me, Romaine, and don't sell yourself too short there. This sell-off and this withdrawal of money seems to be some defensiveness by investors. We are currently characterizing this as a correction, not the impending situation of ultimate difficulty for the markets. We think that the economy actually remains reasonably intact here, and that we're basically going through a situation here where the market is kind of having to eat their spinach before they get to the rest of the main course in terms of fiscal policy in this nation. We think that's actually the primary reason that the market is behaving the way it is.
Well, that's what I'm curious about, too. I mean, there's been a lot of people who've said, look, we're not willing to sort of lower our year-end targets or even lower some of our earnings forecasts because the idea is that, in their opinion, that this might be more short-term pain, and then over the longer term, as we get deeper into the year, maybe we get policies out of Washington that are a little bit more accretive to the economy. At least that's certainly the message that the White House has been trying to send. Do you buy that?
We buy that to some degree. If you think about the policies that are on the table, we are currently implementing the government cost-cutting efforts of DOGE, as well as a number of different tariff proposals or actual implementations that feel like to investors they're probably coming in very rapid and almost in disorganized fashion, although I think that's more the communication of it. And then later this year, the government has been looking to potentially help with the tax situation with tax proposals in Congress. And there's also this aspect of reduced regulations for businesses that should be positive for businesses on the whole. But the reality is we're kind of getting those uglier things first, which is what the market's trying to now digest, and we're having to wait to get the better things from this administration later on.
Right,
and I think that's what the market's dealing with.
Exactly, which is different from President Trump's first term, right? And the longer that gap goes, the more uncertainty there is. So at some point, does the spinach just take over the meal?
I don't think the spinach necessarily takes over the meal unless the meal down the road never comes. And I think there's the other aspect of the spinach in that what we're getting right now in terms of the actual tariffs that are imposed, I actually question if some of those tariffs are exactly what the ultimate end game on those are. There's an aspect of this that they're trying to create a level playing field for international trade. Well, that could be accomplished also by reduced tariffs or better playing field when we go abroad, rather than just increasing our tariffs for everything that comes within the United States.
So what would then stabilize markets until we get to the dessert? And what do you think changes that thesis? Yeah, I'm doubling down on the spinach thing. And where does it change your thesis?
And by the way, I generally like spinach, but we'll keep with this analogy. One of the things that can actually happen is when you're going through a period of digesting the bad news, to some degree, just a slow down in the bad news or some indications that you're at the tail end of it can actually be the catalyst to make things a little bit better. And I think the other thing we need to recognize with a market downturn is a market downturn is not necessarily all bad for investors. The reality is it creates a lower valuation as a starting point entry for any investors that want to come into the market. It actually creates a kind of better projected long-term return for stocks from that point of view. And it actually relieves some of the pressure that we had from higher valuations entering this year.
So it gets to this idea then, Jason, do you find opportunity right now? Meaning, are you brave enough to sort of look at some of the drops that we've seen in these names and buy? And with the idea that this is being bought in the context of longer-term investment gains, not necessarily tactical positioning?
From a longer-term positioning perspective, we have been an advocate of this idea. We were saying last year we didn't want to chase the rally. We wanted to rebalance when opportunities came. This is one of those opportunities to rebalance portfolios. If you had an investment portfolio that was fully invested at the tail end of the year, market down 10%, you're probably looking at an opportunity where rebalancing the portfolio will actually add a little bit into equities. What we don't want to necessarily do as of yet is we don't necessarily want to go over our skis in terms of our equity allocation at this point in time. But quite a lot of accounts I've seen, it looks like there's opportunities to rebalance back to a longer term policy.
All right, Jason, always a great conversation. Jason Pride, Chief of Investment Strategy and Research at Glenmede, helping us count you down to those closing bells, Alex. Those bells a little more than 3 minutes away here, and we are pretty much around the lows of the day. I do just want to bring to the attention of our viewers, we did get a headline just now, this involving Berkshire and the real estate company Compass. The Wall Street Journal reporting that Compass is in talks to actually buy Warren Buffett's real estate brokerage unit. No terms, but this is Home Services of America, which is one of his portfolio companies.
Remember when we were going to see a whole boatload of M&A?
Yeah.
Because the Trump administration?
Yeah.
Are we going to get it?
Well, I mean, this is it. I mean, maybe it's the reverse. I think more people would like to see Buffett buying things rather than selling things.
With all that cash pile. Yeah, probably. Exactly. What does he need that cash for?
But yeah, I don't know, from your lips to God's ears, Alex, at some point, I guess maybe that does materialize. Certainly not for today. And when you look at the market and this idea of being brave enough to come in and buy this dip, what do you buy?
Right, and also raises the question of what would capitulation look like and have we seen it? I have not seen definitive answers. Everyone seems to have conflicting views on that.
The S&P down 1.5%, the NASDAQ down 2%. Full coverage of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to that closing bell. A global simulcast. It starts right now. Scarlett Fu in the TV studio as normal. Carol Masser in the radio booth as normal. Tim Stenovic, for some reason, has the day off. In his place, they had to look far and wide, but they found somebody who could fill those shoes, and that is Matt Miller, the co-host of Open Interest. Welcome to our audiences from across our platforms here, Carol, on another brutal day.
Yeah, exactly. Another day of selling, right? And so it just seems as long as those tariff headlines continue or tariff threats continue, that we continue to see stress on Wall Street because you're just seeing it clear across the board. Matt, do you have anything to say?
Yeah, well, no, for sure. I mean, I've been watching these markets all day. We're looking at, I guess, a correction almost near as damn it to 10% off the S&P 500 highs. Obviously, we're already there on the NASDAQ. My question is, when are we going to know the bottom? I don't know if you guys have seen this chart on the Bloomberg 3116, but what it shows you is the NASDAQ 100 has had huge volume today. And when we've seen more than 75 million shares traded over the past few years, years, you always see a bounce. That is the bottom, and we're seeing that indicator today, so maybe this is it.
I like the note that I read from Dave Lutz over at Jones Trading saying markets occasionally like to find people's pain thresholds, and at the moment, the market is trying to figure out what President Trump and Secretary Bessent are, basically.
And you have to wonder, is that a 15, 20% move in the S&P? Like, is the Trump put there? It just ain't there at 10%.
Yeah, certainly not here. And the real key number that you're looking for right now is that 10% correction on the S&P. Basically, a close below 55.30 would effectively mean that. It takes a while for these numbers to settle, but right now we're right around 55.21 and change, down about 78 points or 1.4% on the S&P 500. Should that number hold, that means the S&P will have drawn down a full 10 percentage points from its all-time high that was set just back on February 19th, which was just 3 weeks ago yesterday. The other indices also taking the punch as well. The Dow Jones Industrial Average down more than 500 points or 1.3%. The NASDAQ Composite down more than 300 points or 2%. And the Russell 2000 is going to lose about 33 points on the day or 1.6%.
All right, everybody, and just digging a little bit deeper into what we saw in the S&P 500, 372 names to the downside on this Thursday and 131 scarlet to the upside.
All right, let's take a look at the IMAP. There's a lot of red, as you'd expect, but there is a little sliver of green there, and that's mainly in the utilities index. Too bad it's one of the smaller sectors in the S&P 500. The actual smallest is materials, and that group is down by 0.1%, also outperforming the broader market. In terms of big decliners, 3 groups finishing down 2% or more. You have communications services, consumer discretionary, which includes home builders, retailers, and automakers, and then you have the real estate investment trust group down, again, 2%.
All right, guys, to the individual gainers, a lot of red on that IMAP, but I did find some gainers. Intel, clearly one of the big movers to the upside in today's trade, up as much as 18.6%, finishing the day with about a gain of 14.6%, top gainer in both the S&P 500 and the NASDAQ 100. Of course, we know we got the news late yesterday about the chip maker naming Lip-Bu Tan as its new CEO, so succeeding to interim co-CEOs. We did have B of A upgrading Intel today to neutral, citing Tan's solid track record. There's still a lot of questions about the future and what Intel looks like going forward, but as our own Ian King reminded, still a big market cap and still a company with about $50 billion in revenue.
No, it's a small market cap. It's only $100 billion.
It's not that small.
Compared to other chip makers we talk about?
So maybe it's a smaller chip player, but he said, don't count it out. All right. Just wait your turn. All right. All right. Let's get to 2 other names. Dollar General up about almost 7% in today's session. This was a top name in the S&P 500. The company came out fourth quarter comp sales topping Wall Street expectations. Analysts also say its annual outlook likely better than some investors feared. And so we did see that name move higher, up about just shy of 7%. Also bringing up Dollar Tree, that was up about 6.5% as well in today's session. And another name, we don't say it much, Fabrinet, up almost 11% in today's sessions. It makes optical components used in data centers, and it did rally after entering a warrant agreement with Amazon to buy up to almost 383,000 shares. So that got that one moving in today's session. Again, up about 11%.
I'm just looking it up. Fabrinet, you say?
Fabrinet. FN is the ticker.
Fabrinet.
Yeah, it's about $8 billion market cap.
$8 billion. So not nearly as big as Intel.
Correct.
I'm looking at Adobe. Last time I checked, it was the biggest loser on the S&P, both in percentage terms and in points. It gave an outlook that was mixed relative to expectations. And actually, BI, Bloomberg Intelligence, said their guidance for 11% growth in annual recurring revenue for its digital media segment was encouraging. But KeyBank, Bernstein, Stifel, Mizuho, they all cut their price targets. And Evercore wrote that the report wasn't strong enough to change the narrative around the stock. So that's a big loser today. Ulta Beauty, I could have chosen, by the way, any of these real consumer-facing companies. Airbnb and CarMax as well got hit hard today, but Ulta is coming out with earnings momentarily, so I thought it would be a good one to focus in on. There's a concern that their guidance from January is at risk now because of the steep drop in let's say consumer confidence after the holiday season and in the beginning of this Trump 2.0 term. That's according to Bloomberg Intelligence. The beauty industry, like all of these big consumer-facing businesses, has been hit by so many things: wildfires, weathers, illnesses. Raymond James is concerned about illnesses. It'll be the first earnings report, the first earnings call for Ulta's new chief Executive Officer Kecia Steelman. So we'll see how that goes. And then Cummins. I could have picked any of the big diesel motor makers or diesel truck makers. And this is kind of counterintuitive, but the EPA is reconsidering regulations on vehicle emissions, as you would expect in the Trump administration, rolling back nitrogen oxide emissions. It would significantly reduce, climate protections, and you would think, oh, that's good for these big diesel makers.
Why
but
not?
the pre-buying for heavy trucks was expected to be much bigger because of new regulations. And if they don't put those new regulations into place, nobody needs to buy a new truck.
Well, yeah, and also, Matt, to that point, a lot of these companies were already sort of changing what they were providing and producing to help that as well.
Ulta Beauty, they are out with their earnings. Matt was just talking about them, and it is a big beat on the bottom line, at least. Fourth quarter EPS, $8.46 a share. The street was looking for $7.12 per share. Net sales, though, that was relatively in line with estimates for $3.5 billion. Comp sales on a percentage basis, the growth there was 1.5%. The street was looking for growth of about 0.8% here. So a beat on the bottom line, a significant beat, it will, in terms of the growth in comp sales, although the aggregate number on net sales at the top there pretty much in line with estimates. And here's your forecast now crossing the wire. For the full year, the company says its net sales will be in a relatively tight range of $11.5 to $11.6 billion. The street on average was looking for 11.6, so basically guiding relatively in line with street estimates.
All right, let's take a look at Rubrik as well. Enterprise software company does some cybersecurity. It is moving higher in after-hours trading by a lot, up 15% after its first quarter revenue forecast beat analyst estimates. It sees first quarter revenue of anywhere from $259 million to $261 million. It's a pretty narrow range, but analysts were looking for $243 million on average. In terms of the full year subscription, recurring revenue, $1.35 billion to $1.36 billion. Again, a narrow range, but higher than what analysts had anticipated, which was $1.31 billion.
All right, let's get to DocuSign. That stock down about 7%, 8% here in the aftermarket. It all has to do with the outlook. First quarter revenue, DocuSign expecting $745 million to $749 million. The street estimate was for $757.2 million. This, again, is their first quarter revenue outlook, so some disappointment, and that is putting pressure on the stock. Looking to the fourth quarter, the quarter that just happened, we saw fourth quarter revenue. That was actually beat at $776.3 million. Fourth quarter EPS, 41 cents a share versus 13 cents year over year. Adjusted EPS for the fourth quarter, 86 cents a share. That was a penny better. But it's all about that first quarter revenue outlook. And you are seeing, wow, the stock actually now up about 2.5%. So a lot of bouncing around here, despite that miss in the forecast. We'll keep an eye. It's now down another 6%. So a lot of volatility.
All right, bouncing all around there. I want to just take a quick look at the bond market here because we have a lot of auctions that happened this week, and they actually went pretty well. And we saw some buying come in today. The 30-year yield had $22 billion worth of issuance. The takedown was just fine. And it makes sense, guys, as we see this volatility, just take a look at earnings, and we see the decline, and we see the S&P in correction territory, that bid for the bond market continuing.
All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. Alex is heading out. I know Scarlett and Romain are going to continue on television. Matt and I continuing on Business Weekend. Guys, I'm going to take a couple of days off, so I will see you on Tuesday. But that's a wrap for our cross-platform coverage.
See you next Tuesday.
And our coverage here continues right here on Bloomberg Television on what I guess really goes down as a historic day. An S&P 500 that closed lower by about 1.5% here on the day, 55.21. That's the level, down 6% on a year-to-date basis. But more importantly, it's down 10% from that all-time high set back in late February, February 19th to be specific. That means technically we are in correction, and technically the bull market that ostensibly began back in late October of 2022, a more than 70% run-up in the S&P 500, that bull market is over. Ed Harrison joins us right now, a Bloomberg opinion columnist down in Washington, D.C. And Ed, maybe make some sense here of just how much, or how quickly, I should say, this market had flipped. Because we were talking about record highs towards the end of last year and even towards the beginning of this year. We were talking about price targets for the year end in the 6,500 range and beyond. Some price targets as high as 7,000, and a lot of euphoria about pro-business policies from a pro-business administration. What happened on the way to that party?
Yeah, I think reality happened there, Romaine, because basically, it was probably mid-February that the jitters from the early parts of the Trump administration really kicked in. I was talking earlier to Carol Masser and Matt about the divergence in the DAX, which is the German index, and the S&P 500, and that's when you saw the big divergence. Certainly from the beginning of the year, we saw that differential, but it really kicked up with the S&P falling from about mid-February, and the DAX really outperforming in that time period.
We always get reminded that the stock market is not the economy is not the stock market. So as much as the S&P 500 has entered a correction, it's not like the economy is falling apart. Far from it. We're looking at a slowdown, but it's still growing. What is the bond market signaling? And given that there's so much concern now about a recession, is the bond market pricing in anything close to a recession?
No, I think that you're right on point when you say that we're talking about a slowdown. I mean, let's go back to September, October timeframe of last year. If you remember, people were talking about the Somme rule. That's where you see the increase in the unemployment rate goes up to a point where it's 0.5% below the previous low in the last 12 months. That was a recession indicator that was triggered. We got the 10-year, the 2-year yield way down below where we are now. We saw that the number of Fed rate cuts were 50 basis points more than we have now. And so, and what's more is the negative surprises, economic surprises, were even greater then, and we were able to pull out of that. That's what caused the Fed to hike 50 basis points right off the bat. So what we're seeing now is, in terms of the actual data, is not as bad as back then. And so really what the bond market is saying is slow down, but potentially could get worse.
Well, I am curious about that potential. I mean, we heard from Howard Lutnick on this network earlier, who made the case for a phenomenal fourth quarter, in his words, saying that basically, the first couple quarters will be pain. He blames that on Biden. The next couple quarters of the year, the last two, will somehow be on Trump. And the idea is that things will be better then. Ed Yardeni lowered his year-end forecast for the year, but made it clear he's not turning bearish. Wei Lee over at BlackRock said something similar. On the short term, she has a lot of concerns. Deeper into the year, she's actually looking for things to be relatively constructive. And that seems to be a narrative that has been repeated by a lot of folks on Wall Street. Is that a narrative that is based on the fundamentals that we know to be true right now?
Yeah, I think that is a narrative that's true right now. The question is can you pull the cord on the anti-growth policies that are causing angst in the market? Because, when you look at jobless claims that came out today, for instance, 220,000, nothing of great importance in terms of a pickup. Nothing's happening there. We'll take a look at retail sales on Monday, see how that is. Really, you can have a slowdown, you can have an increase in the inflation rate, but none of that is saying that it's going to end in a recession per se. It's looking more at this point like a slowdown, and to the degree that the Trump administration blanches as a result of that slowdown, it could be that they pull back on some of the more anti-growth aspects of their policy mix.
Right, but there's a lot of things that have to happen for that fourth quarter, that second half recovery to come through. Ed, I'm glad that Romaine mentioned Ed Yardeni, because his point about how the market is being stress tested right now by the tariff turmoil raises a lot of inflation concerns at the same time that this seemingly shotgun approach to trimming the federal workforce raises a lot of employment concerns. So that leaves the Fed in a little bit of a bind here. How does today's wholesale inflation and yesterday's CPI numbers play into the options, the flexibility that the Federal Reserve may have next week?
What's really interesting about that is what they're going to say in terms of their dot plot, because that will tell us a lot more than per se what Chair Powell will say in the press conferences, because the proof is in the pudding in terms of where they are. I mean, what I imagine he's going to say is these numbers were slightly lower than they were before, but we still have work to do. We'll take a look and see what we do in terms of the UMISH numbers that are going to come out tomorrow. They're going to give us a sense of whether or not we have this unanchored expectations. We have 30-year highs in terms of inflation expectations from consumers based on the last report that we saw. So I think that they're going to hold their cards close to their chest until we actually see the whites of inflation's eyes, the PCE number going over 3%, that would be something that would be very negative for the Fed. They're not expected to cut anyway next time, so they have plenty of time to wait and just sort of say, let's see what happens, let's see what the data look like, and then we'll go from there.
Them and everyone else in the market. Bloomberg's Edward Harrison, thank you so much joining us from Washington. Edward, of course, is the writer of the Everything Risk column. Let's circle back to some of the earnings that we did get after hours. We're looking at shares of Ulta. They are moving higher in the after hours trade by almost 5% after its fourth quarter sales and profit topped analyst estimates. We want to bring in now Dana Telsey, who is founder and CEO at Telsey Advisory Group. Dana, walk us through the numbers and your impression of what's happening at this company, given that the products it sells is mainly reflection of consumers' willingness to splurge on little luxuries.
Exactly. Frankly, and thank you very much for having me. The numbers came in better than expected when you look at the EPS at $8.46, better than the consensus of $7.13. Take a look at the comps at 1.5%, up 0.8 compared to the consensus of up 0.8%. And you take a look at the gross margin and SG&A. Both of those rates were better. Gross margin at 38.2%, up 50 basis points from last year and above consensus, translating into an operating margin of 14.8%, better than the consensus of 12.7%, and even more importantly, exceeded their guidance of the high end of their guided range. Now you look at the guidance for the upcoming fiscal year, and frankly, with the stock moving up like it is, they basically gave indications that were almost in line. You look at the revenues, $11.5 to $11.6 billion. Consensus was sitting there right at around 11.6. The comps a touch lighter at flat to 1% compared to the consensus of 1.2%. Mm-hmm. But you take a look at the EPS that they talked about, and yes, that is a little bit weaker than expected. We want to hear about the cadence of the year on the call. We want to hear about what's happening in terms of the first quarter and what they're seeing. Mm-hmm. But overall, for the first call with the new CEO in such a volatile and frenetic market, they seem to be delivering. And frankly, the weakness of the stock, it's improving a little bit, and we need to get more color on the call.
And I'm so glad you bring up that they have a new CEO. Kessia Steelman is the new CEO, started the job on January 6th in 2025. How much does that contribute to perhaps a more cautious outlook, given that it's her first time at the helm?
Oh, easily could be. I mean, keep in mind, she's been at the company since 2014. She's been the president and COO. The guidance that new CEOs give typically always are a little bit more cautious, and we'll want to hear what she has to say. They have a lot of newness. They just brought in milk makeup. They have new categories they're expanding into in wellness. And if anything, you take a look at their new store openings, which they just highlighted, it'll be around net new 60, which is similar to last year. So they continue to be a key player in beauty.
I am curious, Dana, about how some of the urban expansion that they had. I mean, a lot of their success in the early years was certainly they had a very decidedly sort of suburban strategy and an experiential strategy. And I know that's broadened out a little bit, but I am curious as to whether you see them maybe going back to those roots, not necessarily geographically, but to lean a little bit more into those experiences.
I think what they're doing is they're remodeling some of their existing stores. So you're going to do at least 40 remodels, and that's helping them update those stores in some of those more suburban or rural areas. But keep in mind, the other thing that they've toyed with is that they have a 5,000 square foot box for some of even those smaller market areas. And let's not forget also the Target shop-in-shops that have been a growth vehicle for them.
Mm-hmm. Yeah, that's a good point. Do they need exclusivity in products, Dana, to compete? Does that matter in the way
it
that
does.
maybe
it matters in terms of new introductions.
Yeah. It
matters that they're first to market with things, and whether it was Charlotte Tilbury last year, whether it's milk makeup right now, newness brings in customers, both the mother and the daughter.
All right, and don't forget about some of us men, some of us who are into makeup for reasons, professional reasons. Dana, always a pleasure talking to you. Dana Telsey, founder and CEO over at the Telsey Advisory Group. Coming up here, we're going to focus a little bit more on the tech trade and the AI trade, because since DeepSeek's emergence, companies are working to develop AI models, yes, with fewer chips. Bhaskar Roy going to be joining us. He's the chief of AI products and solutions over at the automation software company Workato. That's coming up after the break right here on The Close. It's been 2 months since the emergence of DeepSeek into the public discourse, and since then, it's sparked a reckoning over just how much tech companies spend to develop their AI systems. AI companies are now working to make software that could run as efficiently as possible with fewer chips. Joining us right now to discuss that is Bhaskar Roy. He's the chief of AI products and solutions at the automation software company Workato, and he also co-founded other companies, including 2 that were acquired by Microsoft, and has held leadership roles at Oracle and HPE. You're a great person to talk to, particularly about the spend. And I am curious as to whether the amount of money that is being spent in aggregate amongst all these companies is really actually changing, or is it just more about taking that same amount of money and just using it more efficiently?
So I think it is changing, Romain. The way I see it is, AI, with the rise of all these various language models and foundation models, it has gotten to a point where it has become a board mandate for most companies. So it's a top-down mandate that's coming, and people are looking at ways that they can transform their businesses. So what we are finding when we talk to our customers is that the AI spending often is in a completely separate kind of a budget, which is allocated towards how they can transform using AI and what that future looks like.
When clients come to you, or potential clients for that matter come to you, and they are looking to sort of utilize or integrate more of AI and the ancillary tools into their products, are they asking you about costs? Is that top of mind, or do they not, or is that sort of secondary? They just want to make whatever changes and improvements first and worry about costs later?
I think what they're starting to see, what we hear from our customers saying is the cost is one element of it, but they're mainly talking about returns on AI investment. So cost is not really the core factor. It is how can we get the fastest return on the AI investments that they're making? And that's where they find themselves stuck and help in terms of are looking for guidance across the board as to how they can get started. What are the key areas that they can get started with? What are the processes that are right for AI and how they can be automated throughout, means using AI across the board? So it's more of a return on investment question rather than a cost-oriented question that we see.
You mentioned how they get stuck. Has anyone figured out a good process to get unstuck? I mean, has anyone come up with best practices to go through that process efficiently so that they can deploy that capital more productively?
I don't think there's a silver bullet here. What they talk about is there are a couple of areas where they get stuck. One is what's the place that we should get started with, right? So they're often stuck as to what are the right processes or what are the right capabilities around AI that we should do in order to get that big bang return that AI promises. The second area that they get stuck in are they are doing a lot of experimentation. There is a lot of testing, a lot of POCs that are going on, but they are not really rolling it out to production to see the kind of returns that they would want to see. And that's where the customers come in and start asking us or looking at various kind of guidance in terms of what are other customers doing, what are the various areas that they should invest in order to see the kind of returns. And often we find those in 3 different buckets. One is how it can help them grow their company, right? In the sense, the sales efficiency side of things, how they can drive revenue growth. The second is how it can help them through in their customer experience so that they're providing a much richer experience to their customers overall. The third is in their back office systems overall as to how they can be operationally more sound and as a result become more agile as they take on this market. So those are the 3 areas that we often hear our customers saying. But there is really, it's mainly how customers are talking about this and understanding as to how other customers are doing things rather than looking at a silver bullet which will solve this particular problem.
Right, okay. We know that FOMO kind of drove the first leg of the build out of everyone's AI systems and their application towards it. Is that still the main driver, or have things calmed down a little bit here because of things like DeepSeek causing a little bit of a rethink in terms of investment, and also, let's face it, the bear market that the Mag 7 names are now in?
Yeah, FOMO is still a big factor. We see that across the board. And that's where I think the customers talking to other folks and other companies as to what they're doing, how they're going about it, is a key aspect of this. And as these customer stories come out, I think people learn from them. So FOMO is still a big factor of that. But that FOMO is in some way, I'll go back to repeating, it's getting translated from board initiatives saying that, hey, What are you doing in AI? Something that we have not seen with most technologies, which is a board pushing top down, that you need to start using AI in order to become more agile, start becoming more innovative as a company.
I am curious, and we only have about a minute left, but I'm curious about the reliability of the technology. And there's been a lot of discussions from companies that have integrated some of this stuff into either their products or in their own internal operations that are now finding issues. And we've talked a lot on this program about hallucinations and other things, but it's at the point where it's starting to show up in annual reports and other regulatory filings, meaning that the risk, at least as those companies see it, is material enough that they need to let investors and, for that matter, regulators know.
Yeah, AI is going to be unpredictable, right? It's probabilistic at best. But there are areas that we look at, which is almost like how do you earn the trust of the users who are interacting with the AI, whether it be through agents or various other sources. Now, the core things that we see in the balancing act are three things, right? As to how you can balance autonomy with human oversight. Right, in the sense when AI is doing certain things, are there people who are looking at it, or are there humans in the loop who can say that, no, this is going wrong, I need you to adjust XYZ to get to the right answer. So that's one balancing act.
All right, Bhaskar, we got to leave it there. Thank you so much for your time today. Bhaskar Roy is Chief of AI Products and Solutions at Workato. Coming up, we'll discuss how tariffs are creating more uncertainty.
The president was totally annoyed that the Europeans did this, and so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
That was Howard Lutnick, the U.S. Commerce Secretary, speaking earlier on Bloomberg. And this after President Trump threatened a 200% tariff on all wines, champagnes, and alcoholic products from the EU if that bloc's 50% levy on American whiskey is not immediately removed. Joining us now is Bloomberg's Josh Wingrove. Josh, so Howard Lutnick spoke this morning. President Trump posted on Truth Social about this possible 200% tariff. And since then, it's been fairly quiet. And my understanding is there are some negotiations taking place right now.
That's right. The Canadians are down here in Washington and are meeting with Secretary Lutnick as we speak. We understand that those meetings include the Ontario Premier, who, of course, backed down a couple of days ago after Lutnick called him and sort of paused his own export tariffs in exchange for this meeting. Some federal ministers are there as well. It's going to be a bit hard to track the bouncing ball on this because this is his last day in office. Carney's about to be sworn in. There'll be new ministers. Everything's in transition right now in Canada. But there's a bunch of Canadians meeting with Howard Lutnick, and we'll be watching that to see what, if any, response the Americans have. Because remember, this is all from those steel and aluminum tariffs that went into effect at 12:01 a.m. on the 12th. And then the Europeans and Canadians responded, and Trump has threatened his own counter-response to the Europeans, the 200% tax on booze that you just mentioned, but he hasn't said anything about the Canadians, and so we're watching that right now. Of course, the Europeans and Canadians would say that their response is only because Trump slapped that 25% tariff on steel and aluminum. And people who were around in the first term will know that Trump did the same thing. It was just much narrower in scope. It was 25% for steel, but they exempted a lot of countries, including Canada, and it was 10% for aluminum. Now, of course, it's 25%. So it is applying to more countries, and that aluminum number is higher. It's much bigger metals tariff, and that's why you're seeing people respond.
Just real quickly, though, Josh, I am curious, when it comes to the negotiations with Canada, this is coming at a time, of course, where your government is in flux right now. And I am curious if that is going to have any sort of material impact on making progress, given that you now have a new leader of the Liberal Party and potentially, maybe in a couple months, a new leader of the country altogether, depending on how your elections shake out.
Yeah, I mean, time will tell. I mean, I live here in D.C. I cover President Trump. My daughter was born here. I'm caught in the middle. But Trump likes to take advantage of sort of what you might call strategic ambiguity. That's a pretty core pillar of a lot of his policy, his foreign policy in particular. Maybe Mark Carney has that as the incoming prime minister, and up in the air right now whether he's going to call an election. It looks like it'll be pretty quickly. And so right now what the Americans are saying is they're going to say their hellos, but maybe wait until after that election to really get down to brass tacks. And that suggests that more tariffs will be coming down the pipe. Remember that April 2nd date that the president is talking about.
Josh Wingrove, who I should point out is in our D.C. bureau, though Canadian pedigree there.
On the middle
And we don't hold it against him at all. One of the best in the business down there for Bloomberg, as we keep a focus here on tariffs and, more importantly, on the economic implications of those tariffs, and more importantly, on the economic implications for the markets. Jurrien Timmer joins us right now. He's Director of Global Macro at Fidelity Investments, joining us on a day where officially, technically, we have now hit correction territory on the S&P 500, that bull market that we've had for the last 24, 28 months or so, effectively, I guess, at an end. We'll see what happens over the next few days. But I am curious, Jurrien, rather than looking at this from that sort of glass half empty perspective, as to whether there's sort of any sort of silver lining in all this. I mean, it was an orderly sell-off. The pullback was not unexpected, although it was certainly painful. Is there anything here that you look at and you think to yourself, this maybe could actually all work out?
Well, thank you for having me on. And yes, we are down 10%. And it's really interesting that the Magnificent Seven are down 22%. The Russell 2000 is down 20%. But the S&P 500 equal weighted index is down 10%. So it's a little bit of a barbell in terms of where the correction is. And of course, European stocks are up 8% year to date. Emerging markets are up 3%. And of course, bond yields are down. Gold is knocking at 3,000. So unlike 2022, it is a more dispersed market, and for anyone with a very diversified portfolio, which should be everyone, of course, the pain gets distributed, and it's not all happening at the same time. But the good news, or the silver lining, as you mentioned, is that earnings are growing double digits. And so this is a valuation correction. And of course, this is the bookend of where we were a few months ago when, after the election, the market repriced itself. And I think the investors maybe a little bit naively assumed the glass was going to be half full and that we were going to have the animal spirits and the deregulation and the extended tax cuts, but without the tariffs. And maybe the tariffs were just a negotiated ploy, or maybe they would come in but be removed very quickly. And I think the markets are now resetting themselves. And of course, that came at a time when valuations were very high and positioning was very bullish. So we're kind of to the other side, and the markets are getting oversold now. So maybe we're getting towards the end of this corrective phase.
What is your general outlook, though, for the economy? Do you think economic conditions will hold up for the rest of the year?
The labor market remains strong, right? And that is really at the core of the economy, right? So private debt levels are not high. That bubble peaked during the financial crisis. Of course, federal debt levels are high, and we do have a possible shutdown, although historically those have come and gone and have been more about theatrics than anything else. But overall, the economy remains pretty resilient. And of course, the big risk is that if the intention behind the tariffs are to on-source supply chains into the U.S., then you would argue that it can't just be a negotiating ploy, because otherwise companies wouldn't really respond to it and they wouldn't build those supply chains. So that is definitely the tail risk here, is that this does kind of go on. But you have earnings growing double digits and unemployment remaining quite low. And at the same time, PEs are now coming down quite a bit. The price to free cash flow ratio is down 5-6 points now from the highs, which were pretty elevated at the end of last year.
Earnings are growing double digit, but the outlook is a lot cloudier than it was just a few weeks ago. And I think about companies like Target and Best Buy warning that they'll have to pass on some they're going to have to pass on some cost increases to the consumer. And I also think about the airlines warning about this current quarter, how they're starting to see consumers pull back quite a bit. When you look at the broad landscape of company announcements, specific items that people are willing to disclose to investors, what discourages you, Jurrien, and what encourages you?
Well, it is looking increasingly like the growth rate in earnings is peaking here. So you look at the 2025 numbers, the 2026 numbers. They're coming down, as they typically do, but still show a sequential increase from 2024. But that growth rate, eventually is going to peak about a year into an earnings recovery, and earnings inflected higher in the fourth quarter of 2023. So I think the glass half full here is that earnings cycles typically last a couple of years, 3 years plus. This bull market is now 29 months old, getting onto the median bull market length of 30 months, which doesn't mean that it's going to end in a month, but just that we're getting to that median. And so even if we are growing earnings at a single digit rate of historical 7-8%, if the PEs get to a more normal level, the market can still advance, but probably with less of an upside slope. And just one thing worth pointing out is that 23 and 24 were years where an increase in the PE greatly amplified a budding earnings cycle, and especially 2024 was the case. And that actually reminds me of 2017 during the administration's first term. I think in 2025, one is going to kind of offset the other rather than amplify it, and that suggests a more two-way market.
Jurrien, I got to ask you about the dollar as well. It's come down a long way from its high in mid-January. How do you see that affecting demand for U.S. assets? American exceptionalism seems to be over. No one's saying it's been extinguished, though.
It hasn't been extinguished, and the U.S. remains a very dynamic, obviously global economic powerhouse, and we certainly can't, we can't discredit that. But the dollar has peaked, which generally is considered a good thing, and actually it peaked around the same time as it did in early 2017 during the first administration. And so there's a little bit of a parallel there. And from an investment's point of view, especially a U.S.-based investor, it does create quite a few opportunities, because not only is especially Europe now maybe taking a more pro-growth stance because it has to fend for itself economically and geopolitically, but you add that weaker dollar and that translates to more portfolio gains. And that convergence of non-U.S. stocks at a time when U.S. stocks are struggling a little bit is really why we have diversified portfolios in the first place. So it's a very welcome change in that sense, in that not everything is going down at the same time.
Uncorrelated assets, of course. Jurrien Timmer of Fidelity Investments, thank you so much for joining us today. All right, let's take a look at where oil prices settled today, because that too is part of the picture here. You can see NYMEX crude down 1.5%, while Brent crude losing 1.4%, both trading in the $60 range. Let's bring in now Ellen Wald. She is energy consultant and fellow at the Atlantic Council's Global Energy Center. Ellen, the Trump administration wanted lower oil prices. That was one of the things that President Trump had talked quite a bit about, and he was hoping that he would be able to use that to pressure Russia into a ceasefire in Ukraine. Is oil going down for the right reasons?
Well, it seems certainly like oil is not necessarily going down because there's a huge amount of new production coming on. Really, we're seeing a lot of uncertainty in terms of the economic outlook, and that's really weighing on prices right now. And then at the same time, these tariffs are also introducing a lot more uncertainty, particularly in commodities. And so that's definitely pushing prices down. And when you combine that with OPEC and, plans that they have soon to increase production, it's all kind of coming together and helping to push prices down. Maybe not for the reasons that President Trump was hoping for.
Right. A lot of times we talk about how tariffs this time around are different because the economy is in a different place than it was back in 2017 when the first Trump administration imposed those tariffs. What about the oil landscape? How is the oil patch different this time around than in 2017, 2018? How are the economics different?
Yeah, this is a completely different oil patch in the United States than the previous Trump administration. And I think that it would be very helpful for them to take that into account. So last time we had a lot more producers all producing, and they were really motivated to just produce and sell as much as they possibly could without regard for break evens or price points. It was really just this drill, baby, drill, produce as much as you can. Now we're in a very different era where we've seen a lot of consolidation in the oil patch. The players are much bigger, they're much better capitalized, and they're being much more strategic about the way that they're producing. So yes, we are producing at all-time highs in the United States, but the producers are being much more strategic. There's a lot of pressure to return value to shareholders, and now that prices are coming down, that pressure is only going to increase. We're seeing more competition for better acreage. We're seeing producers being much more strategic about where they're producing, how much, what wells they're putting into production versus not. And so really, if it's in the best interest of oil producers to curb back and slow down on production, I think we will see that regardless of what President Trump is saying.
Yeah, and our colleague Alex Seal had a chance to catch up with Harold Hamm, of course, the legendary oil company executive, and he was talking the same thing here. Basically, $50 doesn't work, and of course, when you factor in the inflationary aspects of it, even at 66, where we're at right now on WTI, is kind of a tight proposition, if you will. It raises the question, Ellen, why we aren't seeing a little bit more focus on exports, basically taking what we have already rather than trying to drill for more and trying to maximize that. Is there not any sort of wiggle room to do that?
Well, there's definitely room to export more oil. In fact, the way that the U.S. oil refineries work is that we actually can't even use all of the light oil that we're producing because our refineries are set up to use heavier oil. So we have to export more and import some. I do think that the fact that Europe is no longer importing Russian oil has been very helpful to our oil industry and has definitely made our oil exports more valuable. We could definitely concentrate on that, but part of the issue here is, if you're going and you're putting tariffs on all sorts of things, that makes other people warier of buying your products, even oil and potentially even gas. So I think that everything is combined and everything works together, and it could be a growing concern for the international trade.
It's also the uncertainty too, and I mean we talk about what these executives have been telling us. It's not only necessarily that they're upset with the policies, it's more that, they just don't know what the policies are or whether they're going to shift and change over the course of 24 hours. So how do you sort of make, a 2, 3, 4 year investment plan when you don't know if the current conditions are going to last 2 or 3 months? And take Russia, for example. If we do get a peace deal between Russia and Ukraine, a deal that maybe allows Russia to actually put more of their natural resources back onto the market legitimately, do U.S. producers fear that?
That's a huge question. And one of the issues is, we just saw new sanctions on Russian banking institutions today that could potentially prevent European countries from buying Russian natural gas. And they've actually been buying a good amount of Russian LNG. If they can't buy that LNG anymore because of U.S. sanctions, are they going to go back to buying more U.S. LNG, even though it's more expensive? That's an important point. But then say these sanctions, go away in 2 or 3 months if they reach a deal and the hostilities end, suddenly all of those producers that had been relying on more purchases, they could be out, and we could see a huge drop in the LNG market. We could see the oil market again upended if Europe goes back to buying lots and lots of Russian oil. It's a huge question mark, and there really is no way to plan for it because you don't know if it's going to happen until it actually happens.
All right, Ellen, got to leave it there. Ellen Wald, a fellow at the Atlantic Council's Global Energy Center, a closer look here at the commodity space. And we've seen a lot of activity there, Scarlett. Of course, in the metal space, we actually saw prices going up, obviously, because of the tariffs and what that could mean. Yeah. We've seen a lot of downward pressure on energy prices, largely because of concerns about economic conditions.
Absolutely. And you see that reflected in the market scoreboard today, right? Oil prices down, whether it's WTI, whether it's Brent, but not so if it's gold. Gold prices at a record high, just under $3,000 an ounce, and 1.8% advance.
Every time I look at these record highs, I always just think back to those days when Joe Weisenthal would give me heck when he found out that I was a gold bug.
And you're like, look, vindication now, right?
Yeah. I go by his desk every day and just
remind him. Yeah. Well, the S&P 500 in correction territory, the Mag 7 in a bear market.
Absolutely. And take a look at that 10-year yield. The yield space is quite interesting and quite attractive, Scarlett Fu. In fact, right now, the differential in gains on a year-to-date basis between what you would make in fixed income and what you make in the stock market, 7 percentage points.
There you go.
This is the close. All right, let's take a quick look back at this day in history. 13 years ago, when after more than 240 years of publication, the Encyclopedia Britannica shut down its printing press. For Britannica, which was then the oldest continuously published English language encyclopedia, its move was a big signpost moment in the long developing but accelerating shift from printed to digital content. Other areas of printed media, like newspapers and magazines, also were moving in that direction. In fact, the Christian Science Monitor had shut down its daily print publication back in 2008. Newsweek began its transition in 2012, and even Jet Magazine, a fixture on millions of coffee tables around this country, moved completely online in 2014. While some encyclopedia companies did dabble with digital versions as far back as the 1980s, the shift really picked up steam after Microsoft in 1993 debuted that CD-ROM encyclopedia Encarta. Online reference sites also popped up. Global Encyclopedia in 1995, H2G2 in 99, Nupedia in 2000, and then it came in 2001, Wikipedia. It was a game changer. It was free. It could be updated at a moment's notice, and it contained multitudes more information. The English language version of Wikipedia, that boasts 7 million articles. Britannica, for example, had about 100,000. Sales of the printed Britannica peaked in 1990 when it sold about 120,000 sets in the U.S. For 2010, that was the last printed edition. Only 12,000 copies were even printed, and at the time of its announcement in March 2011, at least 4,000 of those 12,000 sets were still unsold. Britannica now gets most of its revenue basically from educational curriculum and annual online subscriptions. But if you're feeling nostalgic and you want to do your research the old-fashioned way, take comfort. World Book still provides a print edition of its encyclopedia, a 22-volume, 100-pound set that you can buy, Scarlett, for $1,200.
I remember World Book. It was like the easy version of the encyclopedias. And by the way, Wikipedia, like source of alternative facts, as opposed to encyclopedias, which tended to have the facts. Okay, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. First up is Donatella Versace. The designer is stepping down as chief creative officer of the brand. She will continue to remain involved as chief brand ambassador, which means philanthropy and charitable ventures.
Interesting, and also an interesting move over at Kering. Timna, who had been in charge of the Balenciaga brand, which is under that Kering umbrella, now going to move to Gucci. And it's kind of interesting. Investors were kind of upset about this. I mean, I guess they liked what he was doing over at Balenciaga. There's some concern. Gucci needs the help, but there's some concerns here that are they just doing that at the expense of another brand that's already successful?
Yeah, starving Peter to feed Paul, that kind of thing. All right, third on the docket is Bernard Arnault. He's the LVMH founder, signaling he could lead the luxury group for the best part of another decade. He's currently 76 years old. Yeah, that's right. And they're looking to raise the age limit for the CEO and chairman to 85 from the current 80 at next month's annual general meeting.
Okay, I have thoughts about that I can't share publicly. But I mean, look, all his children are in charge of like all the individual units, more or less, right now.
Yeah, but he's the top dog.
Okay, all right, but
and he's going to be the top dog.
Well, it's his company, right?
It's his toy store.
It certainly is. We'll be back in a moment. This is Bloomberg. All right, here's what the markets are going to have their eye on over the next 24 hours, a big focus on Europe.
Yeah, BMW will be reporting earnings, yet another company dealing with tariffs and the threat of tariffs.
They're also dealing with potential inflation, and we are going to get inflation reports out of Germany, France, and Spain.
And of course, we've already seen the ECB cut rates to try to address some of the slowdown that they're seeing there.
And we're also going to hear from the NATO Secretary General. He's actually in Washington. He met with President Trump, but the real meeting happens tomorrow right here on Bloomberg Television, 7:30 a.m. Eastern Time.
And at 10 a.m., we get the University of Michigan sentiment numbers. It's the preliminary March numbers, and it is seen deteriorating.
Yeah, I'm really interested in these because we had seen a deterioration coming into this month. Now we're going to really see the impact of that. So tune in for that. We'll have full coverage of all those market moving data points. Balance of Power is coming up next. This is Bloomberg.